Investing often appears as the ultimate path to quick riches and financial freedom, with ads and success stories painting a picture of easy wealth. These stories make it seem like anyone can make a fortune with a few smart moves. However, the reality is far from straightforward. There are several uncomfortable truths about investing that everyone should be aware of before diving in. In this article, we'll unpack these truths to give you a more realistic understanding of the world of investing. By confronting these realities head-on, you'll have a clearer, more honest view of what investing entails, improving your chances of success and making you a more resilient investor. One of the most universal truths in investing is that no matter when you start, you'll always wish you had begun sooner. The magic of compounding rewards those who stay invested for the long haul, and yet, many people only come to this realization after years of missed opportunities. Time is a critical factor in building wealth through investments, and almost everyone regrets not starting earlier. Those lucky enough to begin in their 20s may still wish they'd started even earlier. For others who wait until their 40s or 50s, the missed years are even more painful, as catching up can seem nearly impossible. The earlier you start investing, the more time your capital has to grow. For instance, assuming average market returns, investments tend to double every 7 years. Waiting for the perfect moment to invest, even for a few years, can make a huge difference. It's never too late to start, but beginning early gives you the advantage of time, allowing you to build a substantial portfolio with less effort compared to those who start later. Another common reality that many people face is feeling like they don't have enough money to invest. This sentiment is pervasive. Most people, particularly when just starting out, don't have large sums of money lying around. You might think, I can't afford to invest while still paying bills and handling expenses. The truth is, if you wait until you feel financially ready to invest, you might never start. Investing is rarely an exciting endeavor in the beginning. It can feel boring and insignificant when you're only able to invest a small amount each month and the returns seem tiny. But the people who are willing to sacrifice small luxuries like skipping a vacation or an expensive meal are the ones who ultimately build wealth over time. As your income grows, it's crucial to continue investing, even if the temptation to spend on fun or convenience is high. Creating a habit of consistently investing a portion of your income, no matter the amount, is key to long-term financial success. Many people delay investing due to the belief that certain conditions need to be met before they start. You may have heard, "Now is not a good time to invest," or "I'll start once the economy improves." These types of excuses are common and can keep you on the sidelines indefinitely. The truth is, there will always be some degree of market uncertainty. Economic downturns, political turmoil, rising interest rates, there's never a shortage of reasons to feel cautious. In fact, market uncertainty often creates opportunities. Volatile markets can offer unique entry points for investors willing to take calculated risks. Accepting that uncertainty is a natural part of investing allows you to focus on the long-term picture and avoid becoming paralyzed by fear. Rather than waiting for the perfect conditions, approach investing with a mindset that's prepared to weather ups and downs. In the end, there will always be something to worry about, so it's best to adopt a strategy and stick with it. No strategy consistently outperforms. Even the most successful investing strategies have their ups and downs. What performs exceptionally well in one period may not continue to do so indefinitely. For instance, real estate saw substantial gains between 2020 and 2023, making it appear as a foolproof investment. Similarly, trends like tech stocks or cryptocurrencies have had their moments of glory. However, the reality is that no single asset class or strategy will consistently outperform the market over the long term. Chasing the latest hot trend can lead to disappointment, as markets are cyclical. This is where diversification becomes essential. By spreading your investments across different asset classes, you reduce the risk of being overly exposed to any single market or strategy. Instead of trying to time the market, or constantly switching strategies, focus on building a diversified portfolio and sticking to your plan. A well-thought-out investment strategy is more likely to deliver stable, sustainable returns over time, even if it lacks the excitement of chasing the latest trend. A down market isn't a personal financial crisis. When markets take a downturn, it can feel as though your personal financial progress is being erased. Seeing your portfolio drop by 20 or 30% can be emotionally jarring, but it's essential to remember that downturns are a normal part of the investment cycle. The average stock market sees a drop of at least 20% every 5 years, yet it typically recovers and reaches new highs afterward. If you have a stable income and an emergency fund, a down market shouldn't spell disaster. It's a reminder to remain cautious and prepared, but not a reason to panic and sell everything. Panicking during a downturn can lead to locking in losses, while those who stay invested are more likely to benefit from the eventual recovery. Having a long-term perspective helps you view market declines as temporary rather than as financial ruin. A rising market doesn't mean you're a financial genius. It's easy to feel like a skilled investor when the market is on an upward trend and your portfolio's value is increasing. However, a rising market lifts all boats, meaning that nearly everyone experiences gains in such conditions. Just because your investments are doing well doesn't mean you've suddenly become an expert. For example, during a housing market boom, property owners often feel as though they've made a winning investment simply because the value of their homes has appreciated. The reality is that market conditions, not personal brilliance, are often the driving factor behind these gains. It's essential not to let short-term successes go to your head, as this can lead to impulsive spending or overconfidence in your investing skills. Staying grounded and maintaining a disciplined approach will serve you better in the long run. The long game is key. Focus on sustainable growth. Investing isn't about quick wins, but rather about building wealth over time. Many new investors focus on short-term gains and feel disappointed when their investments don't deliver immediate results. However, building substantial wealth takes patience, discipline, and a commitment to reinvesting earnings. Instead of fixating on quick returns, it's important to focus on sustainable growth. One of the best ways to achieve this is by reinvesting your returns rather than cashing out at the first sign of profit. Compound growth, the process of earning returns on both your initial investment and previous gains, can lead to exponential growth over time. While celebrating short-term success is natural, remember that reinvesting your gains will multiply your wealth in the long run, allowing you to reach your financial goals more effectively. Final thoughts. Investing requires realism and patience. Investing isn't always the fast track to wealth that some advertisements and success stories portray it to be. There are harsh truths that every investor needs to face, from the challenges of starting late to the persistence of market uncertainty. However, by recognizing and accepting these realities, you'll gain a more honest perspective on investing and improve your chances of success. If you're serious about achieving financial freedom, it's essential to stay grounded, avoid impulsive decisions, and maintain a long-term perspective. Making consistent contributions to your investments, diversifying, and staying disciplined will help you build a stable financial foundation. And while the journey may have its ups and downs, understanding these uncomfortable truths will ultimately make you a stronger, more resilient investor. Remember, investing is a marathon, not a sprint, and the rewards will come to those who stay committed over time.